The choice between active and passive investing has long been a subject of debate among investors. And while many passive investors opt for the widely popular MSCI World ETF, there's a compelling case for a different approach. Another passive investing strategy with a unique twist that could potentially amplify your returns. So what's this new strategic element that might be a real game changer and that you should be aware of? Let's find out. Okay, hey there. The topic of today's video is, well, basically passive investing, but with a twist. So let's have a quick look at the table of contents. We're going to start by just briefly discussing what the MSCI World actually is and why it is so important in the world of financial markets. We'll then discuss how you can add a twist to the MSCI passive investing approach and pretty much any other passive strategy as well. We will then, of course, have to explain why this twist actually works. And last but not least, I will actually introduce a second twist that is also something you should be aware of. So let's start with the MSCI World. I'm sure many of my viewers will have heard of this index. As I just said, it's a widely popular, broad market passive investing instrument. And basically for many investment funds all around the world, it serves as a benchmark that the performance of the fund after fees is then compared to. Obviously, many US-based funds will use the S&P 500 as a benchmark, but I know that many investment funds outside of the US in particular will use the MSCI World Index as a reference point. And yeah, what you can see on screen right now is basically, first of all, in the top right corner, the performance of the MSCI World compared to the MSCI Emerging Markets Index and the MSCI All Countries Index. Then at the bottom, you can see basically the sector weights within the MSCI World ETF, as well as the weights per country. And in one of my previous videos, I've actually highlighted why I think the MSCI World might be a little overrated. Like, I'm not saying it's a bad investment vehicle, but you make a couple of very active decisions about where you put your money that many investors, in my opinion, are not aware of. As you can see, the index is heavily concentrated in US names. Then you will obviously also get exposure to lower quality stocks. And last but not least, the index is basically agnostic to valuation, which, to be fair, is true for most passive investment vehicles. And maybe finally something that you should be aware of is that the index is a market cap weighted index, which means that some members of the index, like you can see Apple in the bottom left corner, for example, represent a significant part of the overall index. Apple, as of today, makes up around 5% of the total index, followed by Microsoft with a weight of 4.5%, and then Amazon with a weight of 2.33%. Yeah, and MSCI obviously reveals the long-term returns of the index. So the gross returns since 1988 have been around 7.9% compounded annually. Now, how can we add a twist to this passive investing strategy? Well, here's the MSCI World Quality Index compared to the MSCI World Index. And what you can see here is that basically ever since October 2008, the MSCI World Quality Index has outperformed the regular MSCI World Index by quite a margin. And that's also true over the very long term. So if you look at the top, basically since 1994, the MSCI World Quality Index has compounded at a rate of 11.12%. So that's pretty much a 30-year time period. And the MSCI World Index has compounded, quote unquote, only at a rate of 7.64%. So that's definitely a very significant compounded return difference. All right, here's a chart that Terry Smith, the founder and CEO of Fundsmith, has revealed in one of his investing letters quite a while ago. Basically, it shows the excess return of the quality MSCI World Index compared to the regular MSCI World Index. And he wrote, over the last 25 years, there has never been a rolling 120 month, so that's 10 years, period when quality has not performed as well or better than the MSCI World Quality Index. And arguably the outperformance of the MSCI World Quality Index is even understated, because obviously the MSCI World Index, so the regular index, will also hold quality companies according to the definition by MSCI World, which we will get to in a second, in its portfolio. So if you would exclude the quality companies that are still part of the MSCI World Index, so the regular one, the outperformance of the MSCI World Quality Index would probably be even more significant. So some of you might be wondering, well, what is actually quality? How is quality defined? Basically, in the world of passive investing, it can be considered a so-called factor. And I've just pulled up the MSCI World Quality Index fact sheet and highlighted that according to MSCI, the quality factor consists of 3 elements. So first of all, high returns on equity. Second of all, stable year-over-year earnings growth. And finally, low financial leverage. So all of those are quantitative factors. And interestingly, the quality approach worked everywhere. So not only on a world basis. Now, if we compare the MSCI USA index with the MSCI USA Quality Index, we can see that the quality index has outperformed again ever since 2008. What about Asia? Well, we can recognize the same pattern. And finally, what about the EU or Europe? Again, the quality factor has done significantly better than the non-quality index. Which brings us to the most important question of this video. Why is this the case? Well, to understand this, you obviously have to understand where the return you gain from stocks actually comes from. And over the very long term, revenue growth and earnings growth will be the main drivers of total shareholder return. Now, obviously, if a business can reinvest profits at a higher rate of return, they will see faster growth of their earnings, or they will need less capital to achieve the same earnings or revenue growth that another business would achieve by investing more capital but at a lower rate of return. And this is why Charlie Munger has famously said, over the very long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than 6% return, even if you originally buy it at a huge discount. So what he's referring to is that over the long term, even if there may be some kind of multiple expansion, so valuation multiple expansion, your net return will still be pretty similar to the long-term return on capital earned by the business, assuming that the business is reinvesting all of their profits. And just to continue with the quote, conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price and maybe experience some valuation multiple compression, you'll end up with one hell of a result. And yeah, if you're confused about the formula that I was just showing you on the previous screen, here's an example. If a company, I called it company Y here in a tweet on Twitter, would achieve a return on incremental invested capital of 30%, but would pay out 40% of its net income as a dividend, well, then its long-term sustainable intrinsic value growth rate would be 18%. So that would be 0.3, that's the return on incremental invested capital, multiplied by the money that it is actually reinvesting internally, so 0.6, which gets you an 18% return. Now, what Terry Smith was also pointing out in the letter that I was referencing earlier is that obviously the industry a business operates in plays a significant role when it comes to the long-term returns of the business. There are just some industries that are just generally very chronically poor industries because the players within that industry may have very little pricing power. The industry itself may be incredibly competitive. There may be very little cost discipline within the industry, and so on and so forth. And on the flip side, other industries are just much more attractive. There will be more companies that actually possess a moat that will give them pricing power. There may be a higher level of innovation, just to name a couple of examples here. Yeah, and this chart here is basically showing what I was saying earlier. Over the very long term, the long-term returns of shareholders, so the total shareholder return, will be primarily driven by earnings growth and not so much by the expansion or contraction of the valuation multiple. And again, just to get back to the composition of the MSCI World Quality Index, as highlighted, one key element of the composition of this index is that the businesses within the index should earn high returns on equity, which, based on what we were just saying, explains why over the very long term, the quality-focused indices have outperformed the non-quality focused indices. All right, now finally, I want to wrap it up by adding another twist. Let me show you another very interesting chart. What this chart here is showing you is basically the performance of the MSCI UK index. It is then compared to an index with a quality factor. And then we've got QARP, which stands for quality at a reasonable price. So again, if we look back at the 3 criteria shared by MSCI earlier, one element that we are basically not finding here is price. But as many of my viewers will know, the price you pay for an investment plays a significant role when it comes to the final investment outcome. And I guess we're now getting to the more active side of investing. I think if you actually possess the ability to both identify quality businesses and are then able to identify whether those quality businesses are also trading at an attractive price, which will be a further boost to your investment returns, well, then you will have a very promising future ahead. If you want to learn how to do that, I recommend you get in touch with me to apply for my mentoring program. As of today, I have 2 spots left, so hurry up. And I guess that's all I wanted to say with this video. Take care and see you in one of my next videos.